Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for June 9th, 2019. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 0.72 rose from 0.50 last week. The total count of securities in bullish or bearish patterns decreased 2% to 3,044. The count of bearish stocks decreased 14%, while the count of stocks in bullish patterns increased 24%. The Pirls P&F Market Breadth Summary Chart shows us a market now 4 weeks in bearish territory. Paid subscribers have access to the Open Office Calc data, from which the chart is generated. You may become a paid subscriber via PayPal, Patreon, or Bitcoin. Simply email S2P Market Signal at protonmail.com for payment and access instructions. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your email address in the space provided and click Follow. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 97 points for the 12th decline in 14 weeks. At a negative 329.80 points, it continues below all 7 tops above plus 100 and has fallen below the August 2017 bottom, and continues above the remaining 2 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum. The CCI 20 daily, now in a Woody's downtrend, is at a positive 32.95, up from negative 144.97 last week. The CCI 20 daily is now within the plus or minus 50 range for a Woody's zero-line reject short entry signal if the market decline resumes within a few days. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 12 weeks ago, while the daily CCI 20 began a Woody's downtrend 4 weeks ago. The CCI 20 weekly in a Woody's uptrend at negative 16.18 rose from negative 25.69 last week. At Friday's 6-7 close, it formed a Woody's zero-line reject long entry signal within the plus or minus 50 range required. We will continue following this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: gold and silver and some tech on the top. Oil services, oil, KBW Bank, and some tech on the bottom. Bullish, semis and disk drives have left the bottom 5. Semis and networkers have entered the top 5. Oil services and oil continue in the bottom 5. Bearish, computer hardware has entered the bottom 5. Gold and silver leads the top 5. REITs has left the top 5. Focus this week from www.zerohedge.com. Rates, time, and gold. The last thing central bankers want to see. Authored by Alistair MacLeod via goldmoney.com. We believe the following key points are essential to understand if we expect to transition out of the Federal Reserve private fiat money system. The interest rate fallacy. There is a widespread assumption that interest rates represent the cost of borrowing money, in the narrow sense that it is a rate paid by a borrower. This is true. Monetary policy planners inquire no further. Central bankers then posit that if you reduce the cost of borrowing, that is to say the interest rate, demand for credit increases, and the deployment of that credit in the economy naturally leads to an increase in GDP. Every central planner dreams of consistent growth in GDP, and they seek to achieve it by lowering the cost of borrowing money. The origin of this approach is mathematical. William Stanley Jevons, in his The Theory of Political Economy, first published in 1871, was one of the three discoverers of the theory of marginal utility, and became convinced that mathematics was the key to linking the diverse elements of political science into a unified subject. It was therefore natural for him to treat interest rates as the symptom of supply and demand for money when it passes from one hand to another, with the promise of future repayment. Baumwoerk confirmed interest produced an income for the capitalist and was a cost to the borrowing entrepreneur, but agreed with his mentor. There was also a time preference element, the difference in the value of possessing money today compared with the promise of possessing it at a future date. The easiest way to understand it is that savers are driven mainly by time preference, while borrowers mainly by cost. This was why borrowers had to bid up interest rates to attract savers into lending, the explanation for Gibson's paradox. In those days, money was gold, and currencies were gold substitutes. That is to say, they circulated backed by and freely exchangeable into gold. Gold was the agency by which producers turned the fruits of their labor into the goods and services they needed and desired. Its role was purely temporary. Temporal men valued gold as a good with the special function of being money, but as a good, its actual possession was worth more than just a claim on it in the future. But do they ascribe the same time preference to fiat currency? To find out, we must explore the nature of time preference as a concept. Time preference in classical economics. Time preference is simply the desire to own goods at an earlier date rather than later. This is because everyone prefers immediate ownership to the promise of future ownership. Therefore, the future value of possessing a good must stand at a discount compared with actual possession, and the further into the future actual ownership materializes, the greater the discount. This is time preference, but instead of pricing time preference as if it were a zero coupon bond, we turn it into an annualized interest equivalent. The medium for matching investment and savings is obviously money, because it would be very difficult to coordinate them in a barter economy. It is this function above all else which money facilitates. We take this obvious function so much for granted that we forget that interest rates are actually the expression of time preference, which has its origin in deferring ownership of consumer goods. Intermediation by banks and other financial institutions conceal from us the link between interest and time preference. On the saver's false assumption, he is not parting with his money by depositing it in a bank. The bank appears to be giving the depositor something for nothing in its role as financial intermediator, but it is effectively cutting the link between savers and borrowers. Both parties in a modern economy end up dealing with a bank instead of each other. However, despite a bank's intermediation, the basic relationship between saver and entrepreneur through a bank is the possession of the former's capital for a period of time. It may conceal it, but it cannot get rid of time preference. Time preference and fiat money. Today's economists do not recognize time preference. For them, economics is about Jevons mathematics, state-issued currencies, and the exclusion of human interest. They say we have moved on from the household economics of yesteryear, and they despise classical stick-in-the-muds. But we can see from their repeated failure to tame human action in order to conform to their economic models that modern economists do not have the answers either. All they have done is cover up their failures through monetary inflation. The ubiquity of unbacked state currencies certainly introduces new dimensions into prices and deferred settlement. Not only is the saver isolated from borrowers through bank intermediation and the belief his deposits are still his property, but his savings are debased through monetary inflation without his knowledge. The interest he expects is treated as an inconvenient cost of production to be minimized. Interest earned is taxed as if it were the profit from a capitalist trade and not compensation for a temporary loss of possession. Consequently, the saver has been driven to speculate well beyond the possibility of not being repaid by a borrower by buying equities instead. He swaps credit risk for entrepreneurial risk. And because the expansion of bank credit out of thin air favors the entrepreneur over the saver, the theory goes that over time he is compensated for the loss of interest. The whole system has changed, and even consumers, who under the classical economic model would defer some of their consumption, have become unsecured borrowers themselves. It is this evolution away from the strictures of time preference that has taken us to zero and negative interest rates. Yet, if the cost of money was simply its interest rate, the economy would be permanently mended and there would be no credit cycle. Why on earth it took the planners so long to understand the benefits of free money and to even pay borrowers to borrow would have been a mystery. Yet, experience and an understanding that economics is a human science tells us otherwise. Despite handing out free money, the Eurozone is in a worse economic and systemic condition than it was before the Lehman crisis 10 years ago, with major bank share prices languishing at all-time lows, and all zero interest rates have achieved, together with aggressive monetary debasement, was the deferment of a banking and systemic crisis. But credit cycles still exist. At their root is the issuance of money and credit on terms that do not reflect time preference. The value of ownership compared with the promise of future ownership has to be respected. It is not something a monetary planner can decide because it is wholly a market phenomenon. No one but individual consumers can contribute to the collective judgments that say any species of bird is worth more than two of them in the bush. Ignoring time preference is the fundamental error behind monetary planning. It is why, in a successful economy, monetary intervention by the state is kept to a bare minimum, or preferably banished altogether. Instead, it builds on the error of Jevons' mathematical approach and the banishment of the people's choice of money, which throughout history has been metallic. Gold. The question now arises over the relationship between time preference and gold. We should consider this in the light of historical experience. Fiat currency has always died and been replaced by metallic money. Gold, and likely silver as well, will return to circulate as money. When gold is used as money, time preference obviously applies, given our rule that money is earned and saved on the one hand, and on the other, savings are deployed in the production of goods and services. A saver lending his gold will expect it to be returned at the end of the loan period, with an additional amount to reflect, at a minimum, his time preference, usually in the form of interest. Furthermore, if someone wanted to borrow your gold for a period of time, you would almost certainly place a greater value on the temporary loss of ownership than that reflected in the interest rate for fiat currency. But this supposition ignores monetary inflation. Over history, the expansion in above-ground gold stocks has roughly kept pace with the growth in human population. Fiat currency expands without limitation, and the loss of purchasing power should be taken into account in any calculation of time preference. The fact that this is not reflected in interest rates is a function of central bank suppression of markets and the concealment of time preference through bank intermediation. The last thing central bankers would like to see is value given to time preference. Most of them are probably unaware of its existence, being immersed in the mathematical economics of Jevons and his successors. And when the general public wake up to the suppression of time preference, and therefore the mispricing of all future goods and services, the consequences will almost certainly be astonishing. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary bull bear point and figure market breadth summary chart compiled by Donald Pearl, S2P market signal at protonmail.com. For Santu Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.